Let's have a session on sensitivity analysis. Let's get straight into it. So all sensitivity analysis is that managers will want to look at ARR, NPV, payback, or even just profit. They will just want to look at those calculations, and they might want to know what if we changed revenues by this percent? What if revenues weren't as high as we predicted by 10% or by 20%? Or if they were slightly higher, what would it lead to? You can do the same with the costs. What if the costs were higher? What would happen in that case to ARR, to NPV, to payback? That's all sensitivity analysis is. Sounds more complicated than it is. It's just what if analysis. Why sensitivity analysis is useful, as I said, it allows managers to see the impacts on ARR, on NPV, on payback, if costs and revenues change by a certain percentage. And you could see how the answer would change by a certain percentage. So therefore, it allows managers to take into account the risk within the project. And that's the critical thing. The risk is what you find from sensitivity analysis. Other things to think about is that with sensitivity analysis, it's an important tool because managers have to make many investment decisions. They need to make decisions based on buying machinery, buying capital. It could be marketing spend, how much they should spend for the launch of a new product. Or it could be how much they should spend on staff training to try and get that productivity and that skilled labour force. So they're all the reasons why we should do sensitivity analysis. Let's now just look at an example. So using the same numbers as I've used for the other ARR video, we've got project 1. And we can see here the net inflows are so forth, and it came to an ARR of 10%. So now what I'm going to look at is how much the ARR will change if revenues were 10% higher, so I put adjusted by 10%, or if revenues were 10% lower, and what would be the final impact on ARR. This is what sensitivity analysis is, what if analysis. So if the revenues were adjusted, then that won't affect the first year. I can do that in the other column too. If in this case revenues were 10% higher, so we remember all these numbers are just estimates. So what if they were 10% higher? So 10%, 1.1, and times that by the estimated inflows. So 10 divided by 40. So 1.1 divided by 40, and then we just repeat the same across. So we're just going to adjust these all by 10%. Adjust them all by 10%. And then it's just the same way you always calculate ARR. So ARR is going to be the sum of all your cash flows, including the cost of investment, which is why you always put year 0 in that table. And that comes to 54. The years is still the same. It's still 4. We now need to calculate the average annual return, which is just going to be the total return, which is 54, divided by the amount of years, which is 4. That comes to 13.5. The initial cost of the project is 100. So if we want to calculate the ARR, then it will simply be 100 times by 13 divided by 100, which we know is going to be 13.5%. So 13.5% is what happens to the ARR if you adjust revenues up by 10%. So you get an extra 3.5% in ARR. Now let's look at the impact if it's adjusted downwards. So if revenues are 10% less. So if they're 10% less, then what happens is we've already done the 100 for the cost of investment because we're not changing the costs. You could change the costs, but we're changing the revenue here. And we're going 10% down, so 0.9 times by 0.9 times by the cash flows that we estimated earlier on, which is 40, and then just rinse and repeat across. So 0.9 because 10% downward estimate, and we just adjust all of these cash flows. And then, as always, you add them up. So we add these up. Let's do that. So sum of all of these comes to 26 if you revise them downwards. The years are still the same. And the average annual return will be simply the total returns divided by the number of years, which is 4. And then we need to take the initial cost of the project, which is 100. And that means that the ARR, if revenues are 10% less than expected, than in forecast will simply be 6.5 divided by 100, and that of course is going to come back to 6.5. So we can see that if 10% higher revenues happen, then we're going to get an extra 3.5% on ARR, and if 10% less revenues happen, we're going to get minus 3.5% on ARR. And that might make a difference because you might have your hurdle, which is the amount that you hope to get in terms of the return on your investment, and you might want to compare that back. Maybe your hurdle is 7%, and that would say that if your hurdle was 7%, then it's saying that if you had a 10% less revenues than you forecast, it would actually mean that it's less than the hurdle of 7%, which would suggest that you shouldn't go ahead with the project. So that might be something that managers weigh into their decisions before giving the green light to the project. So I hope that helps on sensitivity analysis, and I'll see you at the next sesh.